Silver just did something nobody expected. And if you missed it, you missed one of the most important 3 days in precious metals history. Monday, silver was at $96. Tuesday, it crashed hard to $77. And right now, on Thursday, it is sitting at $84. That is a $20 swing in just 3 days. 96, 77, 84. Read those numbers again. Let them sink in. Now, I already know what some of you are thinking. Last video, I was warning about the crash. Now I am here talking about the bounce. But that is exactly the point. This is what peak volatility looks like in real time. One day, the world feels like it is ending. Next day, it feels like we are heading to the moon. And if that confuses you, good, because confusion is exactly what this market is designed to create. But by the end of this video, you will not be confused anymore. You will understand exactly what is happening, who is behind it, and what the data is telling us about what comes next. I have delivery notices. I have vault withdrawal numbers. I have open interest data that has not been this low since 2013. And I have proof that the same banks who crashed the price turned around and bought $140 million worth of physical silver at the bottom. $140 million, while they were telling you silver is going lower. I'm going to break all of it down right now, piece by piece. And at the end, I will explain what I believe this volatility is building toward, because there is a pattern forming that I have only seen a handful of times in my career, and every single time it ended the same way. Stay until the end. Before we dive in, if you are new here, welcome to COMEX. This channel exists to show you the data that mainstream media and big bank analysts never want you to see. If that sounds like something you need in your life, hit subscribe right now. It is free and it might be the most valuable financial decision you make today. And if this video gives you even one insight that changes how you see this market, please hit the like button. It helps this channel reach more people who deserve to see this information. COMEX is built on real data and real analysis. No hype, no guessing, just the truth. Now, let us get into it. Let me set the stage for what just happened, because most people are so locked into watching red and green candles that they are completely missing the bigger picture here. Silver was at $96 on Monday. In my previous videos, I told you that the $95 to $102 zone was where silver would make its next major decision. It topped at $96 and then collapsed. Monday to Tuesday, silver fell from 96 to 77. That is a 20% drop in a single day. During a war, during the Strait of Hormuz being shut down by 70%, during Trump publicly saying that the big wave has not even started yet. I explained the margin call mechanics in my last video. If you haven't watched it yet, go watch it, because everything today builds on that foundation. Now, here is what happened after silver hit $77 on Tuesday. It bounced hard. As I record this on Thursday, silver is sitting at $84. That is a $7 recovery off the low in just 2 days. And the one question everyone keeps asking me is simple. Is the crash over? Is it safe to buy? Where does silver go from here? I'm not going to answer that directly because I do not give financial advice on this channel. What I am going to do is show you data that almost nobody else is showing you and let you draw your own conclusions, because the data speaks louder than any opinion I could ever give you. And what the data is saying right now is absolutely extraordinary. Let us start with the most important piece. Pull this up on screen. This is the CME Clearing Daily Delivery Notice for March 2026. COMEX Silver Futures. Business date, March 3rd. Settlement price, $82.92 per ounce. Each contract is 5,000 ounces. That means each contract at that settlement price is worth approximately $414,600. Now, look at who is buying and who is selling, because this is where everything gets interesting. On the issuing side, Goldman Sachs issued 400 contracts. Macquarie issued 200. On the stopping side, which is the buy side, Bank of America stopped 195 contracts. JP Morgan stopped 145. Scotia Capital stopped 65. Morgan Stanley stopped 62. Wells Fargo stopped 50. RBC stopped 60. Total for the day, 607 contracts. Month to date, 5,694 contracts. That is 28.47 million ounces of physical silver standing for delivery in March alone. Now, let me translate those numbers into dollars because this is where your jaw drops. Bank of America, 195 contracts times 5,000 ounces times $82.93 is $80 million. Bank of America bought $80 million worth of physical silver in a single day at the crash price. JP Morgan, 145 contracts, same math, is $60.1 million. JP Morgan bought $60 million worth of physical silver on the same day at the crash price. Combined, that is $140 million of physical silver taken for delivery by just two banks in a single day. $140 million, while the price was crashing, while retail investors were panicking, while social media was screaming that silver was dead. Bank of America and JP Morgan were quietly writing checks for $140 million to take delivery of the actual physical metal. Think about that for a moment. Really think about it. If you believed silver was going lower, if you genuinely thought the price was going to keep crashing, would you spend $80 million buying it? Would you spend $60 million? Nobody on this planet spends $140 million on something they believe will be worth less tomorrow. That is not how banks operate. Banks do not throw away $140 million. They spend $140 million when they believe an asset is deeply undervalued and they want to own as much of it as possible before the price reflects the real value. And here is the part that should make you genuinely angry. JP Morgan, the same JP Morgan that just took delivery of $60 million worth of physical silver, that same JP Morgan currently has an analyst report published that says silver will average $81 an ounce in 2026. $81. They are telling the public silver is going to $81 while they are paying $83 to take physical delivery today. If they actually believed their own analyst report, if they truly thought silver was heading to $81, why would they pay $83 for it right now? Why would anyone buy something for $83 they are publicly telling the world is going to $81? You wouldn't unless that analyst report is not meant for you, unless it's designed to keep retail sellers selling so that the price stays low enough for JP Morgan to keep accumulating physical metal at a discount. That is not a conspiracy theory. That's the delivery data. It's sitting right there on the CME website for anyone who wants to look it up. The problem is most people never look it up. They just read the analyst report and sell. Now, let me show you what's happening inside the COMEX vaults, because this is the second piece of the puzzle, and it's just as important as the delivery data. This is the COMEX Silver Depository Report, activity date March 3rd. Nearly 3 million ounces of silver were removed from the COMEX vaults in a single day. Let me give you the breakdown. CNT Depository, 800,000 ounces withdrawn in one day. Manfra, Tordella, and Brooks, 883,000 ounces withdrawn. Brinks, 600,000 withdrawn, plus another 379,000 adjusted out of registered. International Depository Services, 603,000 withdrawn. Vault after vault after vault. Silver pouring out of the COMEX system. Add it all up, total COMEX registered silver dropped to 87.1 million ounces. Total COMEX silver dropped by 2.953965 million ounces to 352.2 million ounces. Nearly 3 million ounces gone from the vaults in a single day. Now, let me explain why the registered number matters so much. Registered silver is the physical silver that is actually available for delivery. It's the physical metal that can be used to fulfill futures contracts. When registered silver drops, it means the pool of deliverable metal is shrinking. The vaults are getting emptier. And when the vaults get emptier while delivery notices are surging at the same time, you have a situation where supply of deliverable metal is falling, while demand for delivery is rising. That is not a bearish setup. That is the complete opposite of a bearish setup. The physical market is tightening while the paper market is crashing. The same disconnect I've been showing you for weeks. Paper says one thing, physical says the exact opposite. Now, here is the final piece. Open interest. This is the final data from the CME for Tuesday, March 3rd.
Total COMEX silver open interest plunged to 113,326 contracts. That is the lowest open interest level since September 30th, 2013, the lowest in over 12 years. Let me explain what that means. Open interest is the total number of outstanding futures contracts that have not yet been settled.
When open interest drops, it means traders are closing their positions. They are leaving the market entirely. And when open interest drops to a 12-year low during a price crash, it tells you something very specific. The leveraged longs who were driving silver higher have been completely wiped out. Their positions have been liquidated. The margin calls I told you about in my last video did exactly what they were designed to do. The weak hands are gone. The speculative excess has been flushed completely out of the system, and what is left is a market that has been thoroughly cleaned out. Here is why that matters. When open interest hits extreme lows during a crash, it has historically marked the end of the down move. Not the beginning, the end. Because there is almost nobody left to sell. The longs who were going to get stopped out have already been stopped out. The margin calls that were going to hit have already hit. The forced liquidation has run its course. And what remains is a market with almost zero speculative positioning sitting on top of a physical supply situation where banks are taking delivery of $140 million per day, while 3 million ounces are simultaneously leaving the vaults. That is a coiled spring. Selling pressure is exhausted. Physical demand is accelerating, and the price is sitting at $84 after being at $96 just on Monday. Let me connect all three data points together. Banks buying $140 million at crash prices. Vaults losing 3 million ounces in one day. Open interest at a 12-year low. Sellers exhausted. Physical buyers aggressive. Supply tightening rapidly. That combination has historically been the exact setup that comes right before the most violent moves higher in silver. Not the slow, gradual grinds, the violent, explosive moves that happen so fast most people miss the entire thing. Now, let me give you the full historical picture because I think this is the most valuable thing I can show you. I have studied every major silver crash over the past 20 years, 2008, 2011, 2020. The pattern is identical every single time. Price spikes, leverage builds, crash happens, open interest collapses, banks accumulate physical metal at the bottom, vaults tighten, and then the next move begins. In 2008, silver crashed from $21 all the way down to $8. Then it ran to $49. In 2020, silver crashed from $18 down to $12. Then it ran to $30. Every single time, the crash set the stage for a move that completely dwarfed everything that came before it, because the physical metal changed hands. It moved from leveraged speculators who were forced to sell into the hands of institutions who were more than happy to buy. And once that transfer was complete, the market repriced to where the physical fundamentals said it should have been all along. Silver's sitting at $84 right now. It was at $96 on Monday. It was at $77 on Tuesday. The banks bought $140 million at the bottom. 3 million ounces left the vaults in one day. Open interest is at a 12-year low. And the war is still raging. The Strait of Hormuz is still down 70%. Trump is still saying the big wave has not happened yet. Nothing that caused silver to run to $96 in the first place has been resolved. The only thing that changed is the paper price got crushed by margin calls that have now mostly run their course. The volatility you are watching right now, $77 to $96 and everything in between, this is what happens when a market is deciding where it truly wants to go. It is not confusion, it is a fight. And the data I just showed you tells you clearly who is winning that fight. It is not the retail traders who got margin called at $77. It is not the analysts publishing $81 price targets. It is the banks writing $140 million checks for physical metal while the price sits at the lows. Here's the bottom line. When you see a silver crash and you want to know if it is real or if it is a shakeout, check three things.
First, are the banks taking delivery during the crash? If yes, they are using the crash to accumulate. Second, is silver leaving the COMEX vaults during the crash? If yes, physical demand is not falling with the price. Third, is open interest plunging? If yes, the forced selling is running its course. When all three happen simultaneously during a price crash, that has historically been the setup for the next major move higher. The range that silver has been trading in, the 70s on the bottom and the 90s on the top, is not the final destination. It is the loading zone. It is where the transfer of metal from weak hands to strong hands takes place. And when that transfer is complete, when open interest is fully washed out and the vaults are drained and the banks have accumulated what they need, the price leaves the range and it doesn't come back. That is not a prediction. That is what the historical pattern shows every single time without exception. Drop a comment right now. Tell me what you think happens next. Tell me if you believe $77 was the bottom or if more pain is still coming. I will pin the best analysis in the comments. Share this video. The COMEX data took hours to compile, and most people will never see it because they don't know where to look. One share from you could completely change someone else's understanding of this market. This is Con Invests. Follow the data, not the noise.